I was having breakfast at the local diner last Tuesday, and the fellow next to me was checking his phone every 30 seconds. Finally, he turns to me and says, "Warren, I just can't get ahead. I'm putting money into the S&P 500 like everyone tells me to, but at this rate, I'll need 40 years to build real wealth." And I said to him, "Well, that's exactly right. You will." See, here's what nobody wants to tell you. If you're starting with $5,000 and getting the market's average return of about 10% annually, you're looking at over $20,000 in 15 years. That's not retirement money. That's a used car. Now, before you click away thinking I'm about to sell you some get-rich-quick scheme, stay with me. Because what I'm going to share with you today is something I did in the 1950s and 60s that built the foundation of everything that came after. Here's what most people don't realize. Warren Buffett didn't become Warren Buffett by buying Coca-Cola and American Express. Those came later, much later. In my early years, I was buying companies so small you couldn't find them in the newspaper stock tables. I'm talking about companies with market capitalizations under $50 million. Textile mills in New England, regional department stores, insurance companies in Omaha that nobody outside Nebraska had ever heard of. And here's the thing that'll surprise you. From 1957 to 1960, the Buffett Partnership didn't beat the market by a little bit. We averaged 29.2 annual returns, while the Dow Jones returned just 7.4%. Now, you might be thinking, those numbers don't sound that different. Let me show you what that actually means with real dollars. If you'd invested $10,000 with me in 1957 and left it alone for those 12 years, you'd have ended up with about $93,000. That same $10,000 in the Dow? About $22,000. That's the difference between a down payment on a house and paying off your entire mortgage. And the majority of those early returns? They came from tiny companies most investors had never heard of. Now, I know what you're thinking. Warren, you had special knowledge. You had connections. You went to Columbia Business School and studied under Ben Graham. That's partially true. But here's what you're missing. The information I was using, it was all public. I was reading Moody's manuals in the library, annual reports that companies would mail you for free if you just asked. I was looking at the same numbers everyone else could see. The difference wasn't access to information, it was that I was willing to look where others wouldn't. You see, there's this fascinating study that came out of the University of Chicago back in the 1990s. They analyzed stock returns by market capitalization from 1926 to 1993. Over that 67-year period, the smallest 10% of publicly traded companies returned an average of 17.7% annually, while large-cap stocks returned just 11.9%. Now that might sound like a modest difference. 6 percentage points. Big deal, right? Wrong. Over 20 years, $100,000 growing at 11.9% becomes about $900,000 at 17.7%. It becomes over $2,400,000. That's the difference between a comfortable retirement and generational wealth. But here's where it gets really interesting, and a bit frustrating if I'm being honest. Most investors do exactly the opposite of what they should do. They want safety, so they buy what's familiar. They buy Apple because they use an iPhone. They buy Disney because their kids love the movies. They buy Microsoft because it's Microsoft. And I understand that instinct. I really do. When you see a company with a $100 billion market cap, your brain says, well, all those other investors can't be wrong. It feels safe. But let me ask you something. Do you think it's easier for a company to grow from $100 billion to $200 billion? Or from $100 million to $200 million? The small company just needs to double what it's already doing. Maybe they expand to 2 more states. Maybe they add 1 new product line. Maybe they sign a few more clients. The giant? They need to create another $100 billion in value. That's like Apple needing to invent another iPhone-level product. It happens, sure, but the math is just harder. I learned this lesson early with a company called Sanborn Map. This was 1958. The company made detailed maps for insurance companies, showing every fire hydrant, building material, that sort of thing. Boring business. Market cap was about $2 million. But here's what everyone missed. They owned an investment portfolio worth $65 per share, and the stock was trading at $45 per share. You were getting a map-making business for free and buying securities at a 30% discount. I bought it. We eventually got control. We liquidated the portfolio, and we made a 70% return in about 2 years. Could I do that with General Motors? With AT&T? Not a chance. They were too big, too followed, too efficient. Now here's what you need to understand about microcap stocks. And this is crucial. The reason these opportunities exist isn't because the market is stupid, it's because most professional investors literally can't participate. Think about it. If you're managing a billion-dollar mutual fund, you can't buy a company with a $5 million market cap. Even if you wanted to put just 1% of your fund into it, that's $10 million. You'd own the company twice over. It's mathematically impossible. So these small companies exist in what I call an institutional void. The big money can't touch them. And retail investors? Most of them don't even know how to find them. This creates what Ben Graham called Mr. Market's inefficiency. These stocks can trade at prices that make absolutely no rational sense because there's simply not enough attention on them. I saw a company just last year, I won't name it because I don't give specific investment advice, but it was trading at 4 times earnings. 4 times. And it wasn't some dying business. It was growing revenue at 15% annually, had no debt, and was in a stable industry. Why was it so cheap? Because the market cap was only $60 million. Too small for institutions, too unknown for retail investors. It sat there mispriced, waiting for someone to notice. Now you might be thinking, okay, Warren, but these stocks must be risky. There must be a catch. And you're right to think that. Let me be crystal clear. Micro-cap stocks are absolutely more volatile. They're less liquid. Many of them will fail. Some are outright frauds. This is not a game where you put your entire life savings into one unknown company and hope for the best. That's not investing. That's gambling. And I've never been interested in gambling. But here's what I learned and what the data confirms. If you build a diversified portfolio of undervalued micro-cap stocks, and I mean truly undervalued based on earnings, assets, and cash flow, the mathematics work in your favor. A study by professors at Dartmouth, published in 2015, found that a value-weighted portfolio of micro-cap stocks, rebalanced annually, would have turned $10,000 into over $4 million from 1927 to 2014. That's a compound annual growth rate of about 14.2%. The key word there is portfolio, not one stock, not 2 stocks. A basket of opportunities where you've done your homework. So how do you actually do this? How do you find these companies? First, understand what you're looking for. I use the same criteria today that I used 70 years ago. You want companies trading below their intrinsic value. That means looking at price-to-book ratios under 1.5, price-to-earnings under 12, and ideally, companies with more cash than debt. You want businesses you can understand. If you can't explain what the company does to a 12-year-old in 2 sentences, move on. You want management with skin in the game. If the CEO owns less than 5% of the company, I get nervous. If they own 20% or more, now we're talking. Their interests are aligned with yours. And this is critical. You need a catalyst. Something that will make other people eventually recognize the value you're seeing. Maybe it's a new product launch. Maybe it's a share buyback program. Maybe it's an aging CEO who will eventually retire and bring in fresh leadership. Without a catalyst, you can be right about the value and still wait 10 years for the market to agree with you. Here's a concrete example of how to think about this. Let's say you find a small manufacturing company. Market cap, $30 million. Annual earnings, $4 million. That's a PE ratio of 7.5. They have $8 million in cash, $2 million in debt. So net cash of $6 million. They own their factory outright, which a recent appraisal valued at $12 million. So you've got $6 million in net cash plus $12 million in real estate equals $18 million in tangible assets. And the whole company costs $30 million. You're paying $12 million for a business that earns $4 million per year. That's a PE of 3 on the operating business. If that business is stable, growing even modestly, and management is competent, that's the kind of opportunity I built my career on. Look, I'm 89 years old now. I've seen every market cycle you can imagine. Booms, busts, manias, crashes. And here's what I know for certain. The greatest wealth is built by people who are willing to look where others won't. To be patient when others are impatient. To be greedy when others are fearful. The microcap space isn't easy. It requires work. It requires reading financial statements on Saturday mornings while your friends are at brunch. It requires the emotional discipline to hold positions that might not move for a year or two. But if you're young, if you're starting with limited capital, if you genuinely want to build significant wealth rather than just tracking the market, this is your arena. The giants of tomorrow are being built today, right now, in small towns and industrial parks and niche markets that nobody's paying attention to. Amazon was once a microcap. So was Microsoft. So was Berkshire Hathaway, for that matter. You don't need to find the next Amazon. You just need to find good businesses, run by honest people, selling for less than they're worth. Do that repeatedly, with discipline and patience, and I promise you, the math will take care of the rest. Now, if you found this helpful, let me know in the comments. And remember, invest in what you understand and never risk money you can't afford to lose. Until next time.